started talking about building a trading plan. Now, I know whenever I address at a seminar or a large presentation, everybody wants to talk to me about technical indicators, technical analysis, how they're going to make money, how they're going to beat candlestick charts, how they're going to do this, what strategy they're following, what combination of things they're doing to trade the markets. But the fact is, there are only two important things that will help you stay in the markets and succeed. The first is building a trading plan. The second is understanding leverage, margin, types of orders, and stop losses. In other words, risk management and money management. Because there are a million trades available every day. There are an endless amount of trades. But how you find high probability successful trades is a completely different story. And it's all about limiting your risk. And one way to limit your risk and control your risk is to throw your emotions out the door and build yourself a trading plan. Now, in order to become a successful trader, you need to develop a written trading plan, not something in the back of your mind. This is where you put all the necessary trading rules. Now, tonight, I've given you a couple of handouts. These are all different variations of starting points to start building a trading plan. Because a trading plan is not a strategy. A trading plan is not about indicators and oscillators. Okay? It's not about exit points and entry points. It is your Bible. It's your trading Bible. It's a log of all your trades, all your decisions, why you made the decision, how you made the decision. Now, there is no such thing as an ultimate trading plan because there are no two exactly same traders. My trading plan will have nothing to do with your trading plan. My trading plan is based on things I've been doing for 40 years. Okay? I'm a little bit old-fashioned. You may not be. Okay? I decide how many trades I'm going to make a week, what type of assets I'm trading. But every trader has a different style, a different strategy, a different risk tolerance, and different market experiences. It's always better to develop one's own personalized trading plan and modify it as your experience grows. So a trading plan can be thought of as a template for trading the markets or a checklist. Perhaps even a better way to describe a trading plan is that it's a checklist. The checklist will contain each aspect of making a trade, not just a trade, every aspect of that trade. How you will start your day, how you will isolate a trade, how you'll locate a trade, how much you're willing to risk, how long you'll stay in the markets, what time of day you're going to trade, what days of the week you're going to consider trading. In essence, a trading plan will state your overall short and long-term goals as a trader and will provide you with a clear checklist of how to achieve them. In order to build your own trading plan, you should put into it what trading strategies you're going to trade, what currency pairs or assets you're going to trade, and some people think it's crazy, but what your daily routine will be. And we're going to talk about that because you'll see how important your routine is and your schedule is to your trading. Okay, whether you have a full-time job and you only trade a couple nights a week, or whether you're a full-time trader, or whether you're a student, or whether you're a retired person, all comes into play. So the question is, where do I start? And that's a big, big question. Because if you have nothing, it sounds like it's an insurmountable task to build this huge trading plan. But it isn't, because it starts to develop and you add on to it continuously. If you come to my office and look at my desk, there are sticky notes all over everything. There are old-fashioned little file card systems with everything I've ever done. I can go back and show you the first trade I ever made. You know, back in my day, everything was done by hand. But it's important that you have all this and you slowly grow. So you could start out as simple. And like I said, I gave you 3 examples of where to start. But you can figure out where you want to start because all it is say, okay, I'm going to start. Okay. Start wherever you want, but start, because this will act as a blueprint of what you need to do each time you interact with the markets. You will firstly need to backtest all of your strategies. And unfortunately, most of us new traders, or most of the new traders out there, you read something online, or you go to a class, or you download a recording, or you buy an app from some guru out there selling some system or some automated program or some robotic trading program or something that's going to analyze indicators and oscillators. And you can click the 4 indicators you want to give, and it's going to tell you, buy or sell. But the most important thing is, no matter what system you're using, no matter what strategy you're using, is number one, to test it. And as you add on to it, continue to test it. And part of your trading plan will be, as I add indicators, as I change, this is the strategy I'm using now. But next month, I'm going to build a new strategy based on different market conditions. So, for instance, like I said, whenever I see the euro doing something in particular, or I see gold doing something, I can say, you know what, I remember that from a couple years ago, and I saw that same overall movement in gold. It was down to the 1100s, now it's at 1300, but I saw that same pattern, and I use this strategy, and I can go back in my little file cards and pull out what strategy I used way back when and say, okay, and I can back test it real quickly and see it's working today and start using it for that particular trade. Fortunately, today, we have computers. You know, we have Excel spreadsheets. You can do all this. It is easy because you don't have to build these file cards. You can put it all into your Excel spreadsheet, sort it, find it, do everything you want. But it's not simply about making money. It's more about making correct trades. So in addition to your strategies, you need to put your risk tolerance and your money management rules into your trading plan. And we're going to come up with what these, or where to start these from in a minute. Having written strategies. Okay, this is a big problem there. A lot of you don't have written strategies. You haven't written it out. Okay, you're using something that tells you trade now, buy, sell. Okay, you also don't have down your risk tolerance and your money management. Okay, the blueprint is essential for developing the discipline you will lead to your road success, because otherwise we can very easily get yanked into bad trades or investing too much money in a trade. So part of your plan should also isolate what instruments you're willing to trade. And again, one of the biggest mistakes that novice traders make is today, because of online trading, computerized charting, and everything else, it's very, very easy to watch tons of assets. Well, I'll tell you, the first 20 years of my life, I only traded a handful of assets in the agricultural markets. Okay. Today, I would say over the last 5 years, I might have traded 20 different assets. That's it, because you can't be an expert on them all. It's very easy to get sucked into Bitcoin because all the headlines are saying Bitcoin's down the bottom, it's going to sell up, or the euro's tumbled to an all-time low. Unless you're an expert on the euro or Bitcoin, you shouldn't be just jumping on that news headline. Now, moving as far away from strategies and understanding the markets is you need to have a routine. Okay, how you're going to start out your pre-market phase. That means, how do you start out your day? Or how do you start out your, you come home from work and you have 3 hours while the kids are, out at soccer. Okay, what do you do first? Too many people, the first thing they do is open up the ETX trading platform, and they're ready to start making a trade. They haven't looked at the economics calendar. They haven't looked at news headlines. They haven't looked at their charts that they already have set up and look at where the assets are going. Me, the first thing I do is I look at the assets I'm considering or will consider that are in my little hand bush basket of assets. And I look at the charts. I want to see price action. I want to see if I can tell a story. I also want to see if any of them are offering me high probability trading opportunities. In other words, Do I see a market with a strong uptrend or downtrend? Okay. Do I see something saying, okay, let's focus in on this asset? Make sure that you maintain a trading journal which has logs of all your trades. This is important because it allows you to analyze your trades and the success of the plan adopted by you. Now, successes in the market are about pre-market activities, post-market activities, and analyzing every trade you made. Not just did it make money, because a losing trade can still be a successful trade. Doesn't mean it's a profitable trade. It means you did everything right. You made all the right decisions, and you got out of the market with the smallest loss possible. Well, that's a successful trade. Because if you understand that you're going to have so many winning trades, so many losing trades, all you're doing is using your risk management to reduce your risk to the smallest amount possible so that when you have those losing trades, you don't lose your shirt. And so that way, when you have your successful trades, it more than covers your losers. Because be aware, you're going to have bad trades and good trades. Now, your daily routines are crucial for your trading success because based on them, we build a ritual to help us maintain a high level of focus and a state where we perform at our best levels. All top athletes and sportsmen do. If you were competitive, well, what do we have? We have the Soccer World Cup going on. Don't you think all of these guys have training sessions, physical sessions? They have time with their physical therapists. They have times in the locker room. They have times with everything. And all of this is spelled out because they're not going to become a successful athlete by just going out on the field and kicking a ball. They know what their routines are. They know what their plays are. They know all the odds. They know where to be, what to do, how to kick, everything that has to happen. So why are you exempt from that? Your trading plan should contain a written description of what you will do in the markets. This includes things like what is your edge? How do you trade it? When do you trade it? Now, I use the word, it's a made-up word, stick-to-itness. The creation of a trading plan is highly useful as it reduces the possibility of bad or irrational decisions based on emotion. If you have a written trading plan, then you have a trading filter that will filter only high probability trading opportunities. Because if you have this down, no matter what your emotions get you carried away with, if you've got firm rules on how many trades you can make a day or a week or a month, exactly how many open trades you can have in the market, you have in there what your risk reward ratio must be. In other words, how much money are you going to risk and where do you have to put your stop loss to make sure you don't lose more than that? Therefore, if your stop loss has to be too close because the markets are swinging much farther, you just stop and you haven't made that trade because it's not a high probability trade. It's outside of your regimen. The key to discipline and objective trading is to establish a plan where you put all the necessary rules and stick to it. Because if you have all of these things down on a spreadsheet or sticky note and you're clicking them off on your checklist, guess what? You don't get past number 5, you can't make that trade. So ask any 100 traders if they can send you a copy of their trading plan, and I guarantee it, you won't get any. Now, why are you unlike a business owner who generally have a plan in order to provide a strategic vision to employees and stay focused on their primary line of business? Do you think just opening a store, putting the key in the door and paying the rent is going to get you traffic? How do you know how many yellow shirts you should buy, how many pink shirts you buy, what sizes you need to stock, what sizes are selling well, how many smalls to mediums to larges do you need? How do you know that you have enough inventory to generate enough sales dollars? Without a business plan, you don't. So what's any different than being a trader? Trading is a business, whether it's a part-time business or full-time business. Now, there are millions of articles on the web about trading plans. But what separates tonight's class from the rest is I will show you how to create a trading plan in less than 10 minutes by answering a series of simple questions. So the first question is, how many trades will you use to evaluate your performance? Now think about it. Has any of you thought about how often do I evaluate all the trades I've made? When do I sit down and look at how I'm doing? When do I figure out if my strategy is a successful strategy or not? So the answer to this question is base your evaluation period on the number of trades placed, not the amount of time has passed. Now me, I stop everything. I don't make, my rule book says I cannot make another single trade after I've made 10 trades and sat down and done a full analysis. No matter how good the market looks, if it's streaming off my computer, Barry, you'll make $1 million trading this asset right now. My rules say I can't trade it. Now, depending on the type of trader you are, you have to figure it out. I don't make that many trades. So the number for me is 10. This applies to both my swing trading and my day trading activities. On the average, it will take me approximately 3 months to place 10 swing trades, or about 4 days to place 10 day trades. Okay. Some of you guys out there are placing 10 and 20 trades a day. I don't know how you do it because it takes me hours to analyze a trade and make a decision. So I only mention the time element so you can see how long it takes me to place the number of trades based on my trading style. But you have to perform the same math in your own head. So what is the number of trades you will use before evaluating your trading activity? Then you need to identify your key performance matrix. Okay, and I use the keep it simple rule. Okay, did my strategy work? Did I get out of the market with a small loss? Did I make a profit? Was my trade correct? Was my stop loss in the right place? My take profit? Did this strategy work? Is this something I needed to check? Or is the strategy not so successful anymore? Is it waning? Maybe I need to add something more to it. Okay. Now, as crazy it may seem, is what time of day will you trade? Now, I got guys that are retired, guys that are unemployed, guys that are students that, when they come home from running errands, they pop on their computer and they start trading. Then they go out and run some more errands or go play cards or do whatever they're going to do, and they come home and trade some more. Shouldn't be that way. For me, I trade only between 9:50 and 12 o'clock. That's it. Okay. If I can't find a trade, it doesn't mean I've left the markets. I spend the rest of the time doing my analysis because the markets have personalities at different times of day. And you can't understand all those personalities. And you shouldn't be spending your entire day looking for trades and making trades. You should spend your entire day doing your analysis, doing your strategies, improving your trading abilities, checking out the markets, looking at charts, evaluating your previous trades. Now, similar times a day you will trade, keep your trading edge down to 1 or 2 setups when starting out. Too many traders, they want to trade everything under the sun. You can make trades simply from volume, support and resistance, and trend lines. That's it. You don't need it. Or from price action. Or you can simply use candlestick. Because if you're simply looking for your edge for something to tell you when it's got to trade, then that's all you have to look at. Okay. You don't need to get involved. If you feel your list is bubbling up to 20 or more, you would drive yourself crazy trying to respect all of your rules. I mean, I've seen some charts out there that have so much stuff on them that God knows what they're trying to tell you. Yeah, sooner or later, all the lines will cross and maybe tell you how to trade. Now, remember, we talked about identify the assets to trade. Develop a standard methodology for identifying plays. You will first have to ask yourself, what is my time horizon for this trade? Day traders want to focus on events in the news, while long-term traders want to focus on securities that are developing new growth in business. Okay. So if you're a day trader, I'm not saying trade from the news. But if you're a day trader, like most of us are, first thing you have to do is find assets that are trending. Second thing is you have to find assets that have some movement and volatility. and some momentum. Otherwise, you're just wasting your time. So news and headlines can at least help you find the assets that have volatility and momentum to them. Okay. Whatever you're trading on, make sure you identify the plays that you have the highest odds of probability. For day traders, you want to focus on market movers. This provides you with the greatest opportunity for locating stocks or assets that are trending hard with high liquidity. So remember, you need to set a goal. Then, now we finally get to it, is what is your trading strategy? Are you going to look for patterns? Are you going to trade for support and resistance? Are you going to put trend lines on your charts? Are you going to look at trends, volume, and support and resistance? Are you going to get involved in things like Fibonacci and Bollinger Bands and RSI and stochastics? I don't care. It's just another part of your trading plan. But the most important, like I mentioned, is first you have to determine whether the market is trending up, down, or sideways. Because you need to draw core support and resistance levels in your chart. These are going to be confluent value areas that you can watch for price action strategies to form near to trade back in the direction of the dominant markets. But you need to have something, because a market that's sitting sideways or congested doesn't really offer you a high probability trade. So look for price action signals that have formed at confluent levels in the market. Make sure to trade only very obvious and confluent setups. Now we come to one of the most important parts of your trading plan is where to put your stop loss. Okay. This is where you're going to get out of the market. How much can you risk, and where will that asset close? So my rule of thumb, for me, not for you, is no more than 2%. The 2% is based on the threshold of volatility of asset side trade. It may not be suitable for you. It's also based on the amount of money, the amount of experience, and everything else you have. But your stop loss comes from what you can afford to risk on a trade, not where you have to place your stop loss. So in other words, if the euro, or let's say gold for a nice round, is at 1,300, and you think gold's going to go up, that's perfectly fine. But you can only afford to risk $200. So that means that you can only afford to let gold go down a couple dollars period yen. Because if it drops below $200, that's all you can afford for your risk reward ratio. Okay. But market volatility has gold dropping $10 and $15. Well, therefore, you can't make that trade, because guess what? You can't cover the loss, or you have to cut your contract, the size of your trade, way back. Okay. And it's important because you need to know what your risk management is, because that will determine whether you can make that trade. Also, you have to know when you want to exit the market. You've heard the market wizards say, let winners run. Well, once you figure out what that means, please let me know. The greed in you will prevent you from closing your winning trades, even after you hear that little voice in your head telling you the run has come to an end. So when you set up your trade, as well as setting an exit or a stop loss or risk tolerance level and a get out of the market risk, you need to decide how you're going to exit that market. Okay, what is your target point? Because if you say, okay, gold's going to go up $600, and therefore I'm at 3-to-1 ratio, so I have to put I can afford to put my stop loss down to $200 because I'm at 3-to-1 ratio. Okay, you've done all that. Everything works out well. Okay, and your evaluation of the market is gold's going to go up. That's $600. Well, do you get out of the market at that $600, or do you think you're going to let gold ride up because you're so sure now it's going to ride up to 1,000? Before you know it, gold's down to 500, and you're down $100. You're lost $100 ahead. Or will you put a sliding stop loss? At what point will you adjust your stop loss? So for some reason, traders have fooled themselves into thinking that successful trading only boils down to the latest algorithm or technical indicator. This couldn't be farther from the truth. When you are trading, you may forget that there are human beings on the other end of the buy and sell transaction. This is a head-to-head competition, so use right. The bulls or the bears. Part of the game of trading is not revealing your hand. The smart money will constantly force sharp moves up and down in order to throw off little guys before the big move happens. So it's important to understand. The success factor, my friend, begins and ends with a winning attitude. Think about it. When you see your assets have a short hiccup in it, the current uptrend, is your first reaction to sell and lock in profits? Or do you move your stop up so quickly that you are basically begging the market maker to trigger your order? Now, an important part of your trading plan is how much money can you risk per trade? And there's lots of rules of thumb about this. Okay. Some people go by this 8%, no more than 8% of your capital at risk on a trade. I say it's more complicated than that. It's how much money do you have open in the market at this point? Okay. Because even though you're only risking 8% of the trade, if you have 6 trades open, you technically have 48% of your capital all tied up. And Donald Trump does something absurd, or Saudi Arabia does something crazy, and all of a sudden the markets move completely against you. That's a lot of money you have exposed. So not only is it about how much you can risk per trade, where to put your stop loss, and how much market exposure, but how much can you have riding in the market at a point. Now, there's also something more important. Is because too many of us think that the market becomes our buddy. We want to run home from work and get to our buddy. Yeah, we're on Facebook 24/7. We're on Instagram 24/7. We're on every kind of. So we also think that a trading platform is a social media platform. So we're there 24/7. Some given point, it's too easy to get lulled in. So you have to have a rule that after so many trades, you're going to take a break. A break doesn't mean you're not going to make a trade for the next hour. You say after I placed 100 trades, whether they're successful, losing, winning, regardless of how much money I've made, no matter where, I'm taking the weekend off. Doesn't mean you're going away. I'm just not turning on the computer on the platform. Now, this sounds ridiculous. You say, I don't trade when it's a holiday on Monday. When bank holidays come, I don't trade. Forcing yourself to take a day off or 2 days off after so many trades is psychological. It puts you in control. When you realize you're in control of the markets and the markets aren't in control of you, you've moved one step in the right direction, because the markets are always there. You don't always have to respond to their every move. Now, the other thing is you need to have a rule. If you've had a good run, if you started trading in the morning, made a couple trades, and you've made yourself 12% profit, guess what? Close out the rest of your trade, turn off your computer, and go away. Because emotionally, you're too excited. You'll tend to get more risky. You've had a good day, go fishing. Go spend time with the kids. Go out to the mall. Go out to lunch. You've had a very good day. At the same time, if you're down 7.5% of your total portfolio, close your positions and go away. For some reason, the market doesn't like you right now. And believe me, you can think it's actually personal, but there's some days that the market just doesn't like you. Learn to just get up and walk away. So all of these things should be written up in your trading plan. You can start out with the very simple plan. I've given you a copy of this in your handouts, and you can make it and continue to add on to it. But you'll find when you can control what you're doing and you've got everything spelled out in black and white, you would tend to make less emotional responses. And you also tend not to overlook things that you should be checking. And you'd be surprised. But professional traders, successful traders, long-term traders, they all follow this. This isn't something I'm making up to tell you. Okay. Even if you're a bank trader, you have very specific rules, and your computer's requiring you to do this, 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 and this. You might even have to walk over and get it signed off on your boss before you can actually initiate the trade. So there is more to trading than just looking at a chart, going online, going to the ETX platform, and initiating a trade. Now, tomorrow night, our class is on leverage, position size, stop losses, and the different types of trading orders so that you know how to incorporate these in your plan. Like, I never use a market order. I always have a limit order. I always have OCO orders going on. I always have long-term orders open going on because I want to capture every opportunity of the market. So when gold falls to 1100, my ETX system will automatically buy because 1100 is a great price. So it takes 1 second during the day for gold to fall. Maybe the euro, when it hits 108, I don't care. Whenever it hits 108, buy, because I got my stop loss, my take profit. But that's such a low price, I know I'm not going to lose. Well, you'd be surprised how many times, and you can leave an open to cancel order out there for the rest of the year. Bitcoin at $5,000, I'll buy. Okay. So we'll talk about that tomorrow night when we look at limit orders and market orders, stop loss orders, and we look at leverage and margin and how to use these to your advantage, because you'd be surprised. Those simple things can move the odds in your favor. And that's all you're doing, is looking for the most high probability success ratios. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Thank you for supporting ETX, and we'll talk to you again tomorrow night. Have a good evening now.